Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 5th of June. I'm Daniel Lam, your host for the podcast. Finally, the suspension of the US debt ceiling got passed in the nick of time. Moreover, the non-farm payroll last Friday was a strong positive surprise, with employment increasing by 339,000 in May versus consensus at 195,000. However, we do not believe that the Fed is likely to hike rates in June. The unemployment rate provides a more pessimistic update on labor market conditions. It jumped by 30 bips to a 7-month high of 3.7% versus expectations of a smaller increase to 3.5%. This was most likely caused by a decline in the number of self-employed workers and those that are on unpaid leave. The average hourly earnings growth eased from 40 bips month-on-month to 30 bips month-on-month. As such, the aggregate weekly payroll index, which is the product of average hourly earnings, average weekly hours, and non-farm payrolls, that continues to decelerate, which points to a cooling labor market. So thus, for now, we are likely to see continued strong performance from US equities in the very short term because the Fed is unlikely to be hiking rates in June. So as we discussed in the podcast last week, investors are likely to be sticking to their quote-unquote comfort zone. Nonetheless, do not count out Hong Kong China equities. So last Friday, there was a very interesting move in the Hang Seng Index. It was up 4% with nearly twice the average daily turnover versus those that we've seen over the last 2 months. There were reports about a fresh set of stimulus from the Chinese government, especially on the property front, as well as high-profile visits from prominent US corporate leaders. This could be the start of a fresh set of catalysts that may help Hong Kong China equities to recover. Moreover, the suspension of the debt ceiling entails capping federal spending for the next 2 years. So the nonpartisan Congressional Budget Office estimates US $64 billion of spending cuts next year alone. The spending cap also means that the government's hands would be tied in the event that the US enters a recession later this year. Also, the US Treasury is likely to borrow big once the debt ceiling is raised. So this is likely to be sucking liquidity out from the markets at a time when risky assets face headwinds from a global growth slowdown. In that event, the Fed could end its QT policy early, easing some of the liquidity crunch, but perhaps not enough to sustain this AI-driven rally. So while investors have been enjoying the rally in the mega-cap US technology sectors, do not forget to slowly lock in some profit and rotate into other regions, such as Asia ex-Japan and also Japanese equities, where valuation is still cheap versus US equities, and enjoying the structural improvement in corporate governance that may take Japanese equities higher. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.